I think you tend to see lower spending levels on the first generation wealth creators than you do for any given amount of assets. Of course, how much money, if you're a billionaire, you're going to spend more than a millionaire. But a person with $10 million who made that themselves versus a person who inherited 10 million, I think you'll see less spending among the one who made it themselves. I think they just partly maybe because they're new to that and they just feel like, hey, the idea of spending $2,000 a night for a hotel is crazy.
Right.
Maybe I can get there in $500, but I'm never going to get there in $2,000.
Welcome to the Path to Passive podcast, where we talk about building wealth and empowering lifestyle through commercial real estate investing for tech professionals. I always wish that other tech professionals reaching financial freedom had documented their journey along the way, so I'm doing it for the rest of us. Join us as we explore stories, many failures, and lessons learned along the way. I hope you enjoy and subscribe. My guest today is Tad Fallows, Managing Director of Long Angle. Now, I had a blast, a really good time talking with Tad. I learned a lot, and it really was one of these conversations that made me think different, think about a bunch more what ifs, and sort of see the world a little bit different, the investing world, and even about life. And let me tell you why. Just a little bit about Tad here first was that he graduated from Harvard, began his career at McKinsey, went on to bootstrap and sell a global SaaS company without venture capital. And after going through a full liquidity event, he ran into a problem, which was, hey, I've got all this capital. What do I do with it? And where do I get unsolicited advice, right? Where it's just, what do I do with this stuff? And that's why Long Angle came about. That's what, it was built to solve that. Now, Long Angle is a private peer-to-peer led community made up of aligned members, founders, executives, first-generational wealth creators, and some multi-generational wealth holders, managers, so to speak, as well. And it's designed around trust, discretion, real peer-to-peer insight rather than selling. And here's a couple things is that to be qualified, you need to be making at least or have, I think it was about 2.2 million of investable liquidity as well. So there's some really great barriers, really great qualifications to even get into the community with some great benefits as well. But here's the thing. This episode, Tad and I explore 3 questions. These are some of my questions, really, that I was basing this around, which was how first-generation wealth creators think about risk, spending, and growth differently than those who inherit wealth, and where each group trends, tend to index toward. And Tad had some great insights on that. Definitely worth just listening, if nothing else, to that part alone. Second, what actually changes when someone goes through managing, from a $100,000 portfolio to managing 10 million, and what surprisingly doesn't. And so I think it's a really interesting frame on that one, because there's something that we would like to say in tech, which is there's no compression algorithm for experience. And while I maintain that that's still true, it's cool. It's really insightful to hear what doesn't change as well, right? To think, well, it's not this unachievable thing, so to speak, but how do I think about it? And then finally, what it really means to invest at institutional level, where access, incentives, and manager quality matters more than just whatever the next great kind of looking deal looks like. And so this isn't really a what should I invest in episode, or even some of the operations types of episodes I had before, but it's really one of those how to think about episode. And if I'm thinking long-term, how do I go think long-term? So I really enjoyed this episode. I highly recommend, checking this out. There should be chapters as well in this section. And so browse those as well. And this is one that you probably want to listen to more than once. In which case, definitely do. And Tad and his team, Long Angle, have so many resources on their website. I've gone to those. I've checked them out. They're really good reads, really good research. Absolutely go have a look. And they're in the show notes as well. With that, let's get into it and enjoy. Mr. Tad Fallows, super appreciate you being here. Managing Director of Long Angle. You've put together a group, a community, which sometimes get overused, but hearing about what you put together of over 6,000 people and, helping them to allocate their wealth, help them be better people in general, And you've also talked a little bit about how to raise successful children as well, which I thought was a really, really cool part about that, thinking about from a legacy perspective. I'm super stoked to have you here. Thank you for being on the show.
Thank you so much for having me, Stephen. I'm really excited for the conversation.
Yeah, man. So, you know, I really enjoyed getting to learn more about you, and seeing you places like Invest Like a Billionaire from Aspen Funds, Brian Fraser, on other places I just checked out as well. And I'd love for you to talk a little bit about um, how your background, right? You went to Harvard, you scaled up a SaaS company, iLab Solutions, and then ultimately got here to get to Long Angle, this private wealth community, just like we were talking about. And there's I just want to touch on that background briefly, but focus today about that community and really how that started. And of course, we'll dive into some of those lessons along the way.
Yeah. Thanks so much for that. Yeah. So my professional background, after college, I did about 3 years in consulting, and that was a great experience. I thought it was really fun place to spend your early 20s in terms of, at now my age, in my mid 40s, the idea of saying, hey, I'm going to fly to Hong Kong today, and then I'll go to Zurich tomorrow, and then New York, and I'll be in flying first class, staying in these fancy hotels. Sounds awful now, but early 20s, it's amazing. And I don't care if I'm working all night, I get to meet with the CEO of these public companies and all that sort of thing. So it was a really cool experience. But then at the end of that 3 years, I sort of had to either go to business school and kind of get on the partner track there. And I didn't quite feel ready for that. So I figured rather than business school, which I thought would be fun, but would be a little bit more on the kind of analysis and, academic route, wanted to try getting my hands dirty. So I tried starting a software company with a couple of friends of mine. Figured that would be, hey, I'll try it for a couple of years. It won't work out, but rather than, cheaper than business school. And then after that, I'll go back to consulting. Turned out it was successful. We started in 2006, so it was not a good time to raise venture capital. And, I think that ended up being a blessing in disguise, because in 2007, 2008, when we might have otherwise been raising, the capital markets were closed. So we basically it forced us to be a highly efficient, disciplined operation, because we had to be cash flow positive from the beginning. Mm-hmm. So we were fortunate to be able to bootstrap the software company, and then ultimately got it to a pretty good level of success. We got to a little over 75 employees, and we were growing about 50% a year when we sold to a strategic acquirer in 2016. So it was about 10 years to the day from when we started it to when we sold it. Fantastic experience, really good way to learn, really fun to get to hire, 75 people you like, and just sort of build a business. And then when I ended up selling it, we sold to a strategic acquirer, so a big Bay Area tech company. And from a personal finance perspective, that meant that on one day I went from basically having no money or no liquid money, where 95% of my net worth was tied up in this one illiquid microcap stock, to getting a full liquidity event. Because we sold to a strategic, it wasn't a kind of like private equity where you take some chips off the table and you roll equity. It was just, hey, you sign the check, or you sign the deal, and here's the check for it. And so I kind of on one day then had a bunch of these new high net worth or very high net worth questions, whether that was around investing, of, okay, what are alternative assets? How do you think about that? Whether it was around insurance, what's umbrella insurance? Is there any actual need for whole life insurance, or is that just a broker trying to sell it? Things, as you said, around raising kids. My children were very young at the time, about 1 and 3. And so, okay, how do you raise kids with wealth and have that actually be an asset to them and not a liability? So I had a pretty abrupt transition to all of those questions. And those were really the things that led me to start this Long Angle community that you mentioned, where I, looking especially on the asset allocation, financial management side, but not exclusively there, also these other more personal side. I felt like I'd always been a bit of a personal finance hobbyist, and a lot of those questions of, hey, how do I max out a 529 or for my kids, or, how do I max out my 401k, things like that. Those are very well covered in your general mass market, financial media, and you can get solid, unbiased, free advice there. When you get to these questions, like let's say estate planning, where it's, if you look at a general forum, the advice will be, look, there's a $30 million exemption. So no one ever hits it. So don't worry about it. Mm-hmm. And that is accurate, but then it's not particularly useful if you are trying to do that sort of financial planning. And so I felt like all the advice for a lot of these questions was coming from your Credit Suisse or Goldman Sachs or something like that. And it really just wasn't where I wanted to be getting this advice. Not that they didn't have deep subject matter expertise, and not that wealth managers aren't right for some people, but I felt a little bit like asking a barber if you need a haircut sort of thing, where I just wasn't sure the incentives behind this. And so, I remember I was actually talking with a friend of mine who worked at Goldman. I was saying, hey, if I invested with you guys, what about this hedge fund? I think it's cool. And he said, well, we don't have a relationship with them. They don't pay us a placement fee, so we don't invest our clients' money with them. And I was thinking, well, you're already going to charge me 1%. And then you're saying that you won't put my money in a certain place if you're not also getting a kickback from the GP. That just felt like a bridge too far. And I didn't want to be in a situation where I was paying this person, then every time they got advice, I was trying to weigh it against, well, is that really the best thing for me? Or are they saying because they have a different motive? And I just felt like that was going to be a waste of brain power if I had to constantly be thinking about that. So I said, hey, instead, let's set up a group of basically friends of mine who are in a similar situation. So maybe they start a hedge fund, maybe they, start a software company, maybe they were lucky and went early to Facebook or Google or Nvidia or whatever it is. So people who they may not have all the answers, but they're all facing the same questions. And at a minimum, I know that the answer they are giving me is what they're doing themselves and an unbiased perspective. So set up this community. Initially, it was only a couple dozen folks, and kind of a glorified Slack channel that ended up being a lot more broadly held need than I'd originally anticipated. So our community, we've grown over the past 5 years or so to about 6,000 members, as you mentioned, of people in a similar situation of kind of first generation wealth creators. And I've learned doing that, there's a lot of different paths to wealth. There's, as I mentioned, okay, maybe I'm working at one of the Magnificent Seven companies and, making a very solid salary. The RSUs are doing well, et cetera. Maybe it's entrepreneurship. That's not just tech entrepreneurship like mine, but that's people who have done, a roll up in the cardboard box space or the HVAC space or the veterinary space, or maybe they, start a t-shirt printing company or cybersecurity, or all kinds of these. Maybe half of those are tech, but half of those are non-tech.
Right.
And then a lot of people have just been, very hardworking, successful executives across a wide variety of industries, whether that's finance or, something else. And then a long tail of maybe somebody was early in crypto. Maybe they've been very, bullish on real estate and took out debt at the right time, whatever it is, a lot of paths to that wealth there. But people who've gotten to that situation of, okay, I've got a lot more money maybe earlier in my life than I expected and then I grew up with. And now I'm looking to get, this unbiased peer advice on it. So that's kind of what's led us to building Long Angle. And I should mention, when I say I, not just me, sort of the royal I. So I have a couple of partners in doing this.
Yeah. And I saw you have a pretty decent sized team now in there too, checking out the Long Angle site. That's pretty cool. Dude, super cool background. And thanks for taking me through that entire story. I'm trying to, earmark a lot of those questions along the way to pick at some of those, because there's a lot of insights to be, gleaned from that. One of the ones that I just wanted to, I'm sure everyone, listening, they're all from tech. So they're kind of curious, like, tell us a little about what that software company was. And one of the things I just wanted to note before you do is, you were seeing, you were doing things then which kind of are mainstream now, and that seems to be kind of the carry forward too, which becomes a pattern we'll talk about more. But what was emerging then is like, oh, well, of course this is what we do now, right?
Yeah, no, that is very true. So it was 2006 when we started the company, and at the time we were in our mid 20s, and so we decided to start as a software as a service company, which today is obvious. No one would ever make prepackaged software, but at the time, that was not as obvious. There were companies out like Salesforce didn't invent the model by any means, but it was not the universal model. And probably particularly we were selling B2B, enterprise SaaS. And so our customers were universities and hospitals. Without going too far into the details of it, we basically helped with, well, it's actually really cool. If you look at, let's call it Johns Hopkins, one of the biggest research hospitals in the country, they've got probably, hundreds of millions of this super high-end research equipment, and they've got thousands of professors. So it's not like each professor is buying a $10 million worth of equipment in their lab. They sort of buy these things centrally, like your mouse colony, your DNA sequencer, your 10,000x microscope. We had a nuclear reactor on there, all kinds of these sort of fancy advanced equipment. And then the different professors basically have to book time on those. You have to track who's using it. You do a lot of internal accounting for cost transfers. And so it became a sort of ERP-like system for the university or for the hospital. So we were actually literally processing, I think probably $1 billion a year of internal recharges and cost transfers and direct purchases and stuff like that through the software. And so it was actually surprising, or not surprisingly, it was fairly challenging to try and convince a $1 billion organization that they should be relying on these, 320 somethings with this, pushing this idea of SaaS, and don't worry about, your data's in the cloud for, yes, very large, multi-million, 10 of million kind of annual tracking. So going, we basically had a steady 50% a year growth throughout our history. That literally meant the first year we made 20,000, not profit, but revenue. The second year we made 30,000 revenue. The third year we made 45,000 revenue. So by the time we were done, okay, we're going from 5 million ARR this year to 7.5 million next year. That's very exciting.
Yeah.
But going from 30 to 45, especially when you're newly married and trying to convince your wife, this is, really a rocket ship to be on is a little more challenging.
Super cool. That comes with all of its own challenges, I'm sure, too. We're even 10 years ago trying to tell more and more people about, being on the cloud and why that's good. And, that was, you were talking about 10 years previous. So lots of education, no doubt, along the way. But you had, I could ask a ton of questions about that, but we'll just stay on track. Is you ended up exiting that, and you were saying that you went from, this big exit capital event. I think it was something like the 6 figures to 8 figures, and trying to figure out what to do with, this capital and where to place it. And you'd always been a personal finance hobbyist on the side, but I would ask is, did you have, were you thinking about these types of things, like where to place your capital? And, did you have any, meaningful time spent thinking about, alternate investments? Or was it kind of, you get this liquidity and you're thinking like, whole new world, let me go find out what to do here, new problem to solve?
Yeah, it's a great question. I'd say it's probably a little bit of both. I think I'd always been interested in stocks and things like that. And probably if I were to step back for a second, my biggest learning, both from having been through that myself, but also looking at the members of our community, where I've got a sort of sample set of 6,000 people who have had similar journeys, maybe not the exact same numbers before or the end, some of that's full, some smaller numbers, and, a little bit more or less abrupt, but, the story's rhyming there. One thing is that it doesn't have to be that much more complicated or that much different to be managing a portfolio of $10 million versus $100,000. I think there are plenty of people who just take the approach of saying, okay, I had a 60-40 allocation between, say, maybe 60% domestic equities, 20% international, 20% bonds, something like that. It is not crazy or irresponsible to say, well, I'm going to add 2 zeros to each of those positions. So rather than, 60,000 here and 20,000 here, I've got 6 million there and 2 million there. And that does work fine. And I would say that was largely where I started. I felt like I knew enough, and I was fortunate having, lived through in a very small way the dot-com bubble burst, where maybe I had 20,000 that turned into 10,000. And then with the great financial crisis in a somewhat larger way, maybe I had 100,000 that became 50,000. But I knew what that looked like. And I got enough of a sense of my personality to know, okay, I'm not going to panic sell here. I will be annoyed. I'll be frustrated. I'll be kicking myself. But I'm not going to say, okay, well, if it went down to 50,000, now I want to sell out. I had a little bit more of the mentality. I was annoyed. Okay, I can't buy more because it's the same company as before, and now it's at half price. So I want to buy. So I felt comfortable doing it myself. And I wouldn't say I made a sort of one-day step change. And again, I think that is true for a lot of members of our community. But what I did try to do was say, okay, a lot of the stuff that I've been doing today still works. So I don't, and, things like being very conscious of costs, I think is universally true. So I had not worked with a financial advisor before, and saying, okay, if 1% seemed a lot when I had $100,000, and so I'm paying them $1,000 a year. Well, now if you've got 10 million, 1% that is 100,000 a year. And it's in some ways more than that, because that's non-deductible. That's post-tax money. So that's the same as earning 200,000. So I was pretty highly motivated to say, hey, it's worth my time to try and figure this out. And I can afford to make some mistakes. If I make a $50,000 mistake, I've just, saved a quarter's worth of fees. And so, but then there was a set of things, and, happy to talk about this a little bit more. Maybe half of those on the portfolio and potential investment side. So looking more at private markets. And then the other half on the other kind of financial products, like as I mentioned, different kinds of insurance, whether that's umbrella insurance or different kinds of life insurance, or tax structures, trust structures, etc. So in both of those, where I didn't try and force myself, say, hey, I gotta get it all in place this year, but did a lot of learning, had a lot of conversations with the community, and then bit by bit, I think every year got more comfortable with these other ones and kind of started to go more in those directions.
But were you familiar, or how familiar were you with the alternative investing space already?
I would say, it depends whether you call real estate or not. Personally, I don't really think it is. It is not a stock, it is not a bond, but it is such a large asset class that I think it's kind of its own thing. I would not put it within the world of alts. So if you think of private markets as things like private equity being the big one, venture capital, search funds, and then things like oil and gas,
Right.
litigation finance, royalty rights, private credit, all
Mineral
of
rights,
those,
etc.
I was not very familiar with those.
Okay, cool. So uh, I just wanted to baseline that, because even these, community of thousands of members, like, this didn't happen overnight, and so, this took time as well. And so I'm always, it's just so crazy, when I'm, hearing you talk about, or just someone talk about, you hear people talk about their story and they can explain, well, this happened, this happened, this happened. I'm like, yeah, but that was like 10 years, right?
Yeah. Yeah, absolutely. From bootstrapping to selling to 75 people, that took 10 years. Same thing with building this community, or yeah, really getting comfortable with saying, hey, not just do I know what private equity is, I think that's kind of baseline. And then there's all these terms they throw around, which I think is a bit of intentional jargon to sort of try and, the same way if, a doctor or a lawyer is trying to
Sure.
justify, hey, don't question my expertise, I'm going to throw all these words you don't know. That is very true in this private market world. So there's things like DPI, TVPI, MOIC, NOI. There's kind of all these terms which don't really, from real estate, you can talk about NOI and that's really just earnings, right? There's
Right.
no, it's a magic, and cap rate is just basically the PDE multiple. Like, it doesn't
Mhm.
have to be that different of a number. And so very much same thing within the private market landscape. There's a bit of, okay, just learn, you can Google them, you can find what these 20 terms mean, and then you realize they're just synonyms for a normal concept.
Right.
And then beyond that, okay, I understand what private equity is. It's the same thing as owning a public company, but instead you own a private
Right.
company. And, big difference being there's probably a lot of leverage on that to help increase the returns. And you have to believe that the manager who's buying this is able to add value to it by, okay, I'm going to replace management. I'm going to help them go international. I'm going to help them do a roll up. There's a lot of strategies, some of which are very real, some of which are more marketing, but understand that. And then probably the next thing is, okay, how do I pick the good from the bad, and how do I get access to them? And I would say that's really the biggest thing is private markets, where I actually, it's easy to criticize the government, but if you look at our regulatory framework that the SEC has put in place and all this other information, the public markets are actually amazing, where you really do have an enormous amount of information about Apple or Google or any public company. And you also have this incredibly powerful price discovery, where if NVIDIA is trading at $160 today, you have an enormous number of very smart people who've determined that is really what NVIDIA is worth, and they're highly motivated to get that price accurate. So you can basically throw darts at a wall and say, hey, I'm going to buy 30 public companies. As long as it's not over concentrated in one sector, it's not just 30 oil companies, but a variety of companies, you're going to do fine. You're going to get S&P 500 like results. So it's actually a very safe place to have a little fun. Okay, I like Starbucks, I'm going to buy some Starbucks. The price is already correct. That is very much not true in the private market landscape. If you pick 30 random VC funds, you're not going to get great returns. Because you have this dispersion where, and this is very true in VC, but in other ones as well. You've probably seen these charts where the top quartile performers put up 30% IRR, let's say a year, and the bottom quartile performers lose money. And it's not as easy as randomly picking. Because you randomly pick, the bottom quartile performers are the ones who are trying to market you their funds. It's going to be very easy to get into.
Yep.
Your, General Catalyst, Sequoia, et cetera. It's very hard to get access to them. They're not out there looking for your $100,000 check. They're only
Right.
talking with endowments, et cetera. And so identifying the top performers and getting access to them is unfortunately both extremely important in private markets and actually quite difficult in private markets. So that's probably the biggest difference.
That super cool. That's a perfect pivot to the community part as well. But for those listening, like, earmark what Tad was just talking about the check sizes as well, right? And how you with the community, the amount of people in there, it's, you set up your own, just talking about the model of it as it serves a community and how you're able to really have accessibility, because that's what a lot of these private investments are all about too, right? Accessibility. And so being able to get a bunch of people and have you and your team do the legwork to make sure that you're working with those uh, vetted and operators that make sense to invest with, and then offer lower tiers of investments that you can pull people to go and deploy a larger check as well, right?
Yeah, that's right. I would say, I'm not looking to particularly push what we're doing here, but just
Mhm.
to explain what we do. Basically, for any of these private markets, our goal is to try and be investing alongside endowments or alongside pension funds, alongside real institutional investors, as opposed to the funds where they're primarily getting their money from, doctors or dentists or lawyers
Mhm.
who want to be in those institutional caliber portfolios. And yeah, I would say typically your minimums there, of course, it varies, but saying something like 10 or $15 million minimum to get into an institutional caliber fund would not be surprising. And also, if you have great returns, you can afford to be a little bit snobby. So they don't see everybody's money as equal. They want people who they think are sophisticated, who they think are going to be discreet with their information, all that sort of stuff. So there's a lot of who they know will hit their capital calls, because it's often, okay, I commit to 10 million, but that's going to be called over 4 years. And so they need to have full confidence that whoever, if Harvard says they're going to invest 10 million, they will write the check. And you want to make sure that you're in that position. So our goal is to identify those institutional caliber funds. And the reasons being, partly that they have stronger track records. They have less key man risk. If you have a fund with $500 million and 20 employees, it doesn't have this risk of somebody getting hit by a bus as the
Mhm.
solo GP who maybe he's had luck doing venture investing. He's been an angel in 3 promising companies, but if he gets hit by a bus, there's nobody
Yep.
looking after your funds. So it's those. I'd say it's also fee structure. I think a lot of private individuals, when they think about something like venture, private equity, or real estate, honestly, a GP is never going to want to talk about their fee structure. They're not going to want to be transparent that, hey, yes, I have this menu of fees, and this other guy will give you 1 and 10, but I'm charging 3 and 30. But those fees really pile up, and the institutions basically have no tolerance for these excessive fee structures. But often people targeting retail investors will have much higher fee structures, and they
Mhm.
make an enormous difference in your returns. So that's why we try and do the institutional caliber funds. And as you mentioned, to get there, we do probably a combination of 3 things. One is just this feeder fund and pooling the money, where we say, okay, if we have 7,000 people with 100 billion collective assets, if it's a good investment, we can easily hit that, even 8-figure, mid 8-figure minimums, because we know there will be demand for it. So partly it's that economies of scale. Partly it's then we have a number of investment professionals we've hired onto our team. So, used to work at JP Morgan or used to work at these, large banks, and really know how to have these relationships and know how to do this underwriting. And then a third piece, which we're really kind of fortunate, gives us a bit of an unfair advantage, is we have 7,000 people who've been successful in basically every industry out there. And so whatever we're looking at, if we're looking at oil and gas, we'll have members who, run companies in the Permian, whose families have owned ranches in West Texas for, 3 generations, who are execs at pipeline companies. And so we can really help say, okay, I have 10 different people who are all making this pitch about, okay, you should get into exploration and production, or you should get into, mineral rights, or whatever it is. Which of these are the best investors? And they can all look the same on paper, but the people in the industry will say, no, Kyle is the guy to go with. His dad started this company. He's
Sure.
put up these returns here. This guy, doesn't even live in Texas. This guy is trying to, run a fund for this out of Seattle. Like, there's no way this guy knows what he's
And
doing.
operationally, they know the right questions to ask to be like, nah, that sounds like BS, right?
Exactly. And I will say on oil and gas in particular, anybody who's leading with the tax benefits, they are not the one to be putting your money with. If you talk with the actual operators, like, yeah, it's great. Your depletion allowances are great. We love our tax benefits, but this is an economic investment, and they're never talking about it. They're
Exactly.
talking about, their wellhead returns. And so, yeah, we trying to, and that's just an example from oil and gas. But, if you're looking at professional sports investing, stakes in NBA teams, we have people either who were professional athletes or who, are executives at, these companies there. And so try and get that kind of behind the scenes look to complement that with just the normal diligence.
Yeah, they understand the operations, and you have other requirements too, right? That, people are listening, they know an credit investor, but they may not know some of the other requirements that you have. Can you talk a little bit about those and really speak to like what makes the community unique as well?
Sure. Yeah. I mean, so there's basically, you mentioned a credit investor. The SEC is basically defined three tiers of investor. There's a credit investor, which you can either, as you know, make a certain amount, or if you have 1 million in assets. There's a qualified purchaser, which means you have more than 5 million of assets, and then there's level in between called a qualified client, which is 2.2 million of assets. Without getting to the exact nuances there, but most of these investments that are institutional caliber require people to be qualified purchasers, even if you want to participate in a feeder fund there. Our membership, we don't have quite that bar. We have the qualified client bar, which is 2.2 million or above in investable assets. And we also do, so one thing I say, we don't charge any membership fees. So if anybody's listening and interested and think they may want to join, this is not something that's going to cost 10 or 30,000 a year. So zero membership fees, and you get full access, all of the online discussions, et cetera, you can see in these investments. But we don't charge. We do interview every potential member. Initially, my partner Saram and I, we interviewed probably 1,000 people. When it grew beyond that, we actually have a few dozen of our members basically act as volunteer interviewers and just explain, hey, here's what the community is like, here's what to get out of it. And they ask people what they're looking for. So if anybody's interested in joining, if they just go to our website, longangle.com, you click there, it'll set you up with a current member to have a discussion, see if it's a fit. And really, the biggest thing we're looking for is we don't build persona, to use our tech terms. If it's all 30s or 40s guys who live in the Bay Area and work in tech, that's great. But you will get, and I don't say that with any bias, that's what I look like, but you only get one set of views. Right. And same thing if it's only, finance bros in New York, it's one set of views. So we try and have a variety there. And then also, I'd say especially really trying to be very diligent about screening out anyone who is seeing this as looking for clients or looking for investors, because I think people who are fortunate enough to be in the situation are constantly feeling like somebody's selling to them. Yeah. So our, number one guiding principle is that if you're here to learn, you're here to share, that's great. But if you want to get a check from any other member, whether that's as a client or as an investor or, some other euphemism you're going to use for those, we're going to remove you and it's not going to be a fit. And we've had a lot of success of having people, just making that quite clear in the application process.
Super, super important to have that code of ethics, if you will, right? Just that, I mean, in whatever way to have, you'd want to say that, but that everyone being on the same ground there. I'm kind of curious, you talked about that this wasn't the vision from the very start of having this community. What was the vision from the start? What kind of lessons did you learn along the way organizing this community? I mean, you interviewed the first 1,000 people, you and your partner, right? And so what was like some of the aha moments along the way?
Yeah. So I think we intentionally tried not to be building it with this teleological, hey, here's the end state where we'll be in 10 years and let's build there. Try to have it much more of just a dynamic. Let's see what people want. I mean, really, as I mentioned, for the first couple of years, we just set this up out of personal self-interest of saying, hey, we need this information. We want to have these discussions. And here's a set of friends of ours who we will set up these discussions with. And so it was just kind of organically going that way. I think when we got to maybe 100 or somewhere between 100 and 200 members, it was kind of this inflection point where both it started growing more quickly organically, as there was just, initially I knew everybody or Saram knew everybody. And then it's like, okay, it's all friends of somebody I knew. When you get to third or fourth degree connections, I have no idea who these people are. And so part of it was that. And then I think the other one is just, there seemed to be this law of numbers. When you got to a couple hundred people, it wasn't going to organize itself. Somebody had to actually, before that, it can basically treat it like a Slack channel. Yeah. But beyond that, you actually have to kind of roll up your sleeves and do the organization, think about this idea of, okay, we're going to get bad actors trying to get in, how we prevent them getting in. What do we need to do to upgrade our tech infrastructure to make sure that there's an app that can actually handle all these threads properly and that sort of thing.
Definitely.
But then in terms of the things beyond, initially it was just this online discussion community. Probably the biggest aha moment is there was this, what appeared to be a grab bag of other needs that people had, but a very consistent grab bag when you got to the situation where people who, had this fortunate professional success. One, they were interested in these private market alternative asset investments. A lot of them were also interested in putting together a smaller kind of, you might call it a mastermind or a peer group of saying, hey, I want to have 5 or 10 other people who I meet with regularly, and I can really be open book with them. I can actually share my whole portfolio, talk about real numbers, exactly what I'm invested in, the questions I'm grappling with, maybe personal questions around the kids, et cetera. And I want to have a kind of mastermind, not specific to investing, but really for, what's going on in my life, both personally, professionally, financially. That was a common need. A lot of people were interested in, hey, are there ways that we can leverage our kind of collective scale to get access to discounts? So not just in the investing world, but whether that is things like, flights or hotels or
Sure.
insurance products or things like that. And so people had probably a pretty similar set of questions, a pretty similar set of objectives. So we've tried to just, one by one, help facilitate those objectives. And yeah, it's, so far been pretty successful.
Really meeting the needs of them. I'm looking at the time and I'm thinking about what types of questions I want to and what themes I want to hit on here next. You have been on different podcasts, and I could ask you questions you've already asked or been asked and answered many times here. But let's kind of streamline a couple of these and go through a couple of these themes. So let's talk about the type of when people are obviously coming to the community, they're thinking about this from an asset allocation, and it's probably finance first, but then they round out the rest of their lives. Is that a fair assessment?
I would say people come to the community because they are looking for this unbiased advice, and people in a similar situation. Very few people are coming saying, hey, I'm interested in investing in one of these private equity funds. It ends up once they're in the community and they see them, a lot of people say, hey, that actually does look really compelling. I do want to invest in that. But really what draws people in, I would say, is much more this, I've got a bunch of questions and I want information I can trust about them.
Okay. Is there, if I remember correctly, it's, you were talking about, the backgrounds people are in, they're executives, they might have been in entrepreneurship, they might have been early started one of the tech companies. There are many paths to getting to that level of financial area that they're in right now. Would you, my question is moving toward this, where these statements are alluding to this question of, I've always had this thinking, this learning I've had of, you have to, personally develop as, for lack of better words, at a certain level so that you can, deal with, handle life properly and also make decisions with your finance as well. Do you see a correlation to level of, personal development and how they handle their, finances, but also, I guess, the rest of their life as well?
Yeah, I mean, I would say that like any group of people, you're going to have a huge spectrum of, people's personalities, people's strengths, people's weaknesses. Probably the biggest learning that anyone who's had a significant financial event will tell you is that it doesn't change that much. You wake up the next morning and again, if you were overweight the day before, you're overweight that morning. And if you have a good or a bad relationship with your kids, you still have a good or bad relationship with your kids. So there's a lot more that doesn't change than does change. And, if you look at the sort of personality profiles of the people in the community, they look very much like a standard distribution of the general population. One thing I do think that, especially for entrepreneurs, they're fortunate about in this personal finance world is I think starting a business sort of forces you to just, whether you want to or not, get a deep understanding of all these financial concepts. So I have a very dear friend who she was I think English major at Yale and has no interest in money. She just has a passion for this. And she then worked for Teach for America, but she ended up buying a bookshop. And buying a bookshop forced her to be an entrepreneur. And so then she's always calling me for advice saying, okay, well, I've got this free cash flow thing here. And I'm thinking about, restructuring my debt profile this way to, push out the loan terms, et cetera. And so that act of running a business kind of forces you to get comfortable with these ideas of, cash flow and capital allocation and, HR and insurance and all that kind of thing, which I think both makes you more comfortable with investment because if you look at any company, no matter how big or small or successful, these same principles apply. And then just this other constellation of products that you might need to buy, you just sort of get a familiarity with. So I would say a lot of people come in being like a well-rounded generalist and having at least a level of comfort and familiarity with a lot of these concepts. And then I think similarly, like your listeners working in tech, if someone is, let's say, an engineer at, Facebook, maybe they haven't been first forced to think about Facebook's cash flow, but that engineer mindset of really digging into the numbers and thinking about, okay, well, you're saying it's 75 basis points, but over the course of 30 years, that's actually 20% of my portfolio. So that's a really big number. And, understanding intuitively mathematical concepts like compound interest.
Yep.
I think they also come in with a strong kind of arming here. So I don't think anybody that comes in fully formed at any point in their life, right? You're continuing to develop. I was actually listening to have this conversation with Morgan Housel, who, is an author on these personal finance topics. And I think he calls it the end of history fallacy, where everyone can look at themselves. Let's say you're at age 40, you can say, well, I'm a very different person than age 30. I have different priorities. Maybe I care a lot more about my family than I did before I had kids, or maybe I care more about religion than I did before I had kids, or my community when I was moving around every year versus living somewhere for 10 years. And again, at 30, you look very different than 20, where you're, doing different things in your life. But there's sort of this fallacy of, okay, well, where I am today is who I'm going to be. The things I prioritize today, the things I care about, the things I enjoy. Whereas backward looking, that looks insane. There's sort of intuitively, you assume that, okay, I have reached maturity now. So I think probably all of us are. And when thinking about making a lot of these decisions about, what do I want to do? That's one thing that I found helpful in talking with him and others, is trying to leave yourself flexibility to recognize that you're not at the end of your personal history, and that's likely to continue to evolve throughout time.
Yeah, I saw you do a LinkedIn post about this too. In your themes, one thought track here, you give a couple in the different decades, but another was about the destination and then the journey. Also, it was about the tiering of respect being at the very highest, and just kind of some of those reflections along the way. I did want to ask, this is, people are here to hear some, things definitely about life but also about investing. And, before
Yeah.
we started recording, you were asking about, do people want to hear about real estate, or, that's only one slice of it, which may not be alts, but, there's a whole bunch of other things as well. So what are you seeing in your community about people allocating their money, their funds across these different asset types?
Yeah. And so I can share probably more quantitative answers, both qualitative, but we actually do this annual benchmarking study where we've done 4 of them now. We're going to do another one in a few months, where we survey all of our members and ask them across about 60 different asset classes. How do you actually, how do you allocate your portfolio here? We also ask some questions on the debt side and the income side to try and put that in context. And so the answers I give, and this is our typical member, let's say their median net worth is somewhere in the $10 to $15 million range. They're probably in their, early 40s, might be a sort of middle of the distribution there, probably a couple little kids at home, most of them living in the US, but this is all across the US, not just San Francisco or New York or LA.
Mm-hmm.
So with that as kind of the demographic that I'm talking about, probably at a high level, they're going to have about half of their money in public equities, then the other half in other asset classes. It is not going to look like your typical quote typical 60-40 portfolio. They're only going to have about 5% of their money in bonds. I think the half of their money that is not in public equities is going to be by and large in other high return assets that have, I'll call it equity like returns. So if equities, on the long term can return maybe 8 or 10% historically, other asset classes, so things like private credit, private equity, real estate, crypto, et cetera, that all have interesting, significant return profiles. And the basic idea here being that, I forget who said it, but somebody said diversification is the only free lunch in personal finance. And I really think that's true. So if you have Ray Dalio, who started Bridgewater, his thesis was basically, if you could put together 20 different asset classes, all of which have very high expected returns, let's call it 20%, and all of which are completely uncorrelated, then what you'd end up is you're going to get a 20% zero risk portfolio where you're just going to post 20% every year. Now that's a nirvana. You're not actually going to get there. But the idea is if you can, and what we see our members try and do is layer together multiple of these asset classes that are, I would never claim they're totally uncorrelated because that's, hubris, but are less than perfectly correlated. and that all have high expected returns. And again, in retrospect, you'll know if those expectations were right. But if you look at the historical returns, and so probably the biggest asset class outside of public equities is private equity. And that is, it sounds like a very concrete term. There's actually really a spectrum of these different kinds. So on the smallest side, you have things like angel investments, or maybe things like search funds, which are basically, you've got a recent business school graduate, you give that man or woman, collectively their investors give them a few $100,000 to live for a couple of years while they search for a company to buy. And those investors get right of first refusal to participate in that purchase. And with the idea being that at these microcap companies that are making maybe $1 million or $2 million a year of profit and might have been run by the same person for 30 years, who aren't necessarily being optimized, if that energetic, smart, young business school person can then maybe double their EBIT and also double their multiple, they can get a 4x return without any particular heroics. And so it actually tends to be a very good return profile, up through things like venture capital, mid-tier private equity, or even very large private equity, which looks a lot like public equities. Then you've got a lot of debt-like instruments, private credit, and again, within private credit. And that basically just means, rather than a public bond, it is these private institutions lending to companies. And the big difference with bonds is they tend to have significantly higher returns. And to my point around, you have to know what you're doing. Done wrong, that comes with significantly higher risk. Done correctly, you have a private credit firm that both is very good at the underwriting, is big enough to create a diversified portfolio, so not overexposed to one sector, which could have a problem, and then also has the ability to take the keys. So if they are lending to a company, a manufacturer, who then runs into trouble, that private credit firm, if it's properly structured and adequately scaled, can actually take over the ownership position, run that. And, the good funds will actually make more money on the ones where they default and they get, call it, quote, loan to own. They'll make the most money there. And then you've got the sort of whole slew of other kinds of things. I mentioned oil and gas. I actually really like that sector. Some really interesting, I'd say that's one where it's probably especially important to be with the best operators, which tend not to be the best marketers. The really good operators have no interest in your money. The people who are, constantly calling you and pitching you on depletion allowances don't know what they're doing. But, I think oil and gas, as I mentioned, things like royalties, like litigation finance is another example that's super interesting, where basically you have people, and some people will say, hey, this seems unethical. I think as you dig into it more, there's actually a case where it's a social good, with the idea being that somebody has very legitimately been harmed by, say, a big company, but they can't possibly afford the lawsuit themselves. So rather than the big company being able to just stiff arm them and say, hey, I don't believe you can afford to hire a lawyer, so go pound sand, you're, helping to fund those lawsuits. Regardless of whether I think it's a good or a bad thing, it is a very uncorrelated asset, because what you are entirely betting on is whether this lawsuit, or really this portfolio of lawsuits, will have good returns, which has almost no correlation to what's happening in, with COVID or with the stock market or with geopolitics. So there's that third bucket of just kind of other assets, or again, crypto is one that I'm sure your listeners are familiar with. That's going to be another, kind of alternative asset. We don't do a lot there because we try and do things where we think we can really underwrite, and, institutional level funds would have an advantage. I don't know that, I've seen a lot of crypto deals there like that, as opposed to more speculation.
Yeah, maybe not yet, but regardless, that was like a really, really cool overview of, comprehensive on asset allocation. Because I've had people on that were just on the litigation funds, that were just on, any of these other asset classes, but looking at that big picture. I only have a couple minutes left, but I do want to ask this one. I had a lot of questions, but I want to ask this one in particular, which was, you have a lot of first gen people that come into the group as well. Are you, what are you seeing some of those traits, some of those, mindset, not mindset, but you know what I mean? The things that are obvious, like this is newer money versus, this is kind of ingrained in someone and they've grew up in that family. What are those things you're seeing? What, and how can, what are some of those things that people, concepts that flip people from taking that newer stuff to thinking, more like it's just been part of them generational wealth wise?
Yeah, that's a fantastic question. I'd say we have far more people in that first generation category. It's maybe 5% who are in this, hey, my father, my grandfather, my great grandfather generated this family wealth. So to me, that's maybe kind of the normal perspective, but to say kind of what is different between those perspectives. One thing that's interesting to me is I've noticed a far higher comfort with taking risk and kind of making decisions that go in a different direction with the first generation wealth creators than people who are second or third or fourth generation. I think somebody who was fortunate enough to make $20 million, they certainly don't want to lose that money, but they both have a confidence of, okay, I figured out how to make this. I probably could make it again if I really had to. And they also feel real ownership of this money of, hey, this was success that I built myself. It wasn't success I inherited. I think somebody who is second or third generation often feels a bit of, hey, this is not my money to lose. So I think you hear words like stewardship of, and I don't mean this is either a positive or a negative, just the mindset of, hey, I am the current steward of this capital, but I am not the last steward and I'm not the first steward. And so my job is to make sure that yes, I want it to grow, but above all, I want it not to disappear. I think a lot of your first generation wealth creators are probably, while they don't want it to disappear, they also don't want it to sit idle. They might say, okay, if I'm 40 now, I think I have another 40 or 50 years. If I can double that money every decade versus every 2 decades, it's just going to be a much different outcome. And they don't feel comfortable. They work extremely hard for this, and they don't feel comfortable feeling like the money is then not working as hard for decades there. So that's probably why they do less of things like bonds, where they feel like, hey, I know I'm not going to get a great return on this, and I'm not willing to accept a not great return. I think that's a big one. Another one is, and this may be surprising, I think you tend to see lower spending levels on the first generation wealth creators than you do on for any given amount of assets. Of course, how much money, if you're a billionaire, you're going to spend more than a millionaire. But a person with $10 million who made that themselves versus a person who inherited 10 million, I think you'll see less spending among the one who made it themselves. I think they just, partly maybe because they're new to that and they just feel like, hey, the idea of spending $2,000 a night for a hotel is crazy.
Right.
Maybe I can get there in $500, but I'm never going to get there in $2,000. Or I'm not going to be willing to pay a wealth manager because I'm paying that guy $100,000 a year. I could do it myself. Right. So across a variety of these, some of it is just sort of, and I can certainly identify, these I'll describe myself, that. And I think they also, though, look at it kind of from a, passive income perspective, where I think people really like this idea of, okay, if my portfolio spits out X in terms of dividends or in terms of, low risk rents, even if they're still working, often thinking about their spending in the context either of what can my portfolio do or what can my day job do, as opposed to sort of the combination of the two. So yeah, I'd see less consumption of luxury goods.
I think what's really interesting about that one, and I'll mention the insight and then ask a quick follow-up here, and then I unfortunately our time has come to an end here, is it seems like it's the distance to the money, right? The bucket to people who inherit it, and it's not mine. I'm here as steward to preserve and grow it, maybe more conservatively, but versus the bucket one, which is they earned it. It's theirs. They don't want to lose it, and they might be more comfortable at taking risks. Is kind of this. They might be more attached to it because they earned it and it's theirs, but they're more comfortable taking risks at the same time, right?
Yeah. A little bit of paradox in there, but I think that's certainly true.
Do you think that there's somewhere in between, which is kind of the most mature aspect of it, of knowing which risks to take? And I say knowing which risks to take, and that's seems like the right thing to say, but do you ever really know? Like, you want to be risk taking but not too conservative, so maybe a middle ground?
I think probably the biggest thing is that, and certainly true, guilty of this myself, but people jumping to tactics before they know their objectives. So I was listening to this talk from a guy who, he's, I think, second generation, but he was talking, he does a lot of advising other families, saying, okay, in his case is, what estate structure do you want to put into place? And so what set of trusts and things like that. And he said, he was polling the audience. He said, okay, how many of you have your estate structure in place? And maybe it was, 60 or 70%. And they said, okay, how many of you know what you're trying to accomplish with the estate structure? And it was literally 0%. And the comments were all, no idea, don't know, unsure, haven't thought about it. And I think the same thing in investing. There's a lot of, hey, that's a really cool private credit fund. I mean, I go in there, but without the first, well, what am I actually trying to do? Am I actually trying to minimize my risk, which is generally what a financial advisor would say? Am I trying to maximize my charitable request when I die? Am I trying to buy a place in Paris? am I trying to just live off my cash flow? So I think spending a little, and there's never going to be a perfect answer. As I said, your desires can evolve over time, et cetera, but probably having a little more clarity on where am I trying to go? Because the how am I going to get there? Those are the fun,
Right.
the sexy toys. And, again, myself included, I love to dig into the fund and see if it's a cool investment, but actually thinking first about where am I trying to drive the car?
Yeah. Outcomes first, always. Know your objectives, right? Tad, man, I'd love to have you again on in the future sometime. I really, really enjoyed the conversation. There's so much to dig into, and I feel like we're, it was great background, but we're getting into like even more fun topics around this. Even, selfishly for myself, and just bringing this back to, the listeners, and I'm sure people want to hear it. But you mentioned it a couple of times, talk about some of the resources that are on the site. So though, I'll put the site in the show notes, all the things, but you've got some great research on there too. You talked about the survey you're going to do there as well. Talk about that a little bit, and we'll send people there to go find those things too.
Yeah, and I would say we publish as much of this publicly as we can while protecting member confidentiality. So even if someone says, "Hey, I'm not yet a qualified client, I don't want to join," if you go to our website, you can download any of these for free. And so we do a lot of reports. As I said, we do this asset allocation report. We do an income and spending report. We're actually about to publish our first annual professional services. So asking people, okay, how do you hire, nannies and housekeepers and accountants and lawyers and all that sort of stuff, and how much are you paying them? And so if you go to our website, longangle.com, there's a bunch of that data available there. I also try and post a lot of things on LinkedIn against Tad Fallows. And so you follow me there. I try and share, either interesting conversations or interesting, surveys we've done or things like that.
And by the way, congrats. You guys just had an event as well in Sonoma, if I saw correctly.
Yeah, that was super fun. We had about 300 members, got together for a long weekend in Sonoma. It was a great experience.
Awesome. Thank you, Ted. Appreciate having you on.
Thanks for having me, Stephen.
Thanks for joining us on another episode of Path to Passive. We love connecting with our listeners and those on the path to architecting their wealth and improving their lives. Feel free to let us know what topics you'd like to see in future episodes. Get in touch with us through email or Instagram. See you next week for a new episode.